Let's Talk Money.
Welcome back. You're with us on Let's Talk Money, and this week we are discussing ways in which you can diversify into global equities, buy global stocks. There are mutual funds that you can, go with. There are different platforms. You can buy shares directly. So all of that is being discussed. And we have another query coming in. Vijay Javrekar is joining us on the show now. Vijay, welcome to Let's Talk Money. What's your question?
My name is Vijay Zabdekar. I am a Merchant Navy officer serving in the Merchant Navy for the last 19 years. My query is related to the remittances that we earn a monthly salary in, that is the USD. Following the theme of the show, I wanted to ask how do we use the remittance to invest in international stocks in India?
Okay, all right. Vijay got that. I don't know if that makes a difference. The thing is maybe that since he's getting, his salary in USD, he doesn't have to, deal with the forex conversion. I'm guessing that's one less hassle to contend with.
Yeah, I guess he's got money lying in US dollars, right?
Yeah,
And
in dollar
he
accounts.
can just remit that. See, I think the operational perspective is that whether you have rupees or you have dollars, you will have to remit into a bank account because the brokerages are not a bank.
Sure.
They all have bank affiliation.
Sure.
So essentially, whether you have rupees or dollars, you'll have to remit the money into US dollars, and then you can either buy stocks or you can buy funds or you can buy bonds.
Okay.
So if you already have dollars, it's easier. You don't have to take into account the currency conversion from rupee into dollar.
Sure.
If you have rupees, then of course that's the additional leg that you have to kind of take into consideration.
Okay, fair enough. So in Vijay's case, it's one less step that you have to sort of endure and go through in order to go and invest in global stocks. Which brings me to the other question, right? We've discussed Indian mutual funds. We've discussed the whole DIY approach through broking and trading platforms. Now tell us a little more about these other funds, which are not really mutual funds, but funds apparently that are set up through which one can go and invest. What are the threshold limits? How does one do it?
Yeah, I think typically the threshold limits are like $25,000, right? So they are not really purely retail kind of products. These funds do invest in global markets. In a structural sense, they probably work like a mutual fund that people are familiar with. They have a NAV concept, right? And essentially why it becomes efficient for the investor is because you get a basket of securities, right? The fund manager is taking the call. The entire execution is on the fund management company. And effectively, the big advantage is that you don't actually have a tax liability till you actually redeem units of the fund. So the fund could be buying and selling stocks or buying and selling bonds, but only when you actually exit the units that you are holding, you essentially end up incurring a liability. Now, this is different from a DIY where each time you're buying and selling, essentially at that point in time, you have a tax liability as far as your global income in India is concerned.
Okay, fair enough. So it works very much like a mutual fund.
Exactly.
In that sense, but the
Exactly.
ticket sizes are larger, the
That's right.
investment
That's
thresholds
right.
are larger.
That's
What about costs for those who have that kind of money to invest?
So typically these costs, Surabhi, are like 1% a year.
Okay, so again, comparable to mutual funds.
Exactly.
Got that. Okay, we have one more query. Let me quickly get to it. This is Karan, who is writing in from Mumbai. He is asking if investing in global markets via domestic brokers is safe. Are there, since there are lots of overseas counterparties involved, could there be a risk of me losing my money? Valid question, right?
Yeah, I think that's what we had discussed earlier in the show, that it's important for the investors to do diligence on who are the platform providers, what is their background, their vintage. So I would not just go and give money to anyone. I would do my own diligence and definitely work with people who've had good experience and they have good vintage as far as financial services is concerned. So it's a very relevant question. And I think people should not get caught up in the exuberance and they should really kind of do some homework. And that's one of the risks of DIY, right? Because the entire due diligence risk is then on the individual investor versus giving money to a fund because the fund then makes
the onus is on them.
That's right.
Which also, leads me to the next question, that if you are doing a DIY, where do the securities lie? I mean, here, if I buy a Reliance or if I buy an ICICI Bank, it's lying in my Demat account.
So
how do you hold these securities?
So very similar to India. Basically, you will have a custodian which a brokerage has an affiliation to.
Okay.
So the securities will basically lie in the custody account, and then you get a statement from them. That's not a very difficult process.
Okay. Also taxation. So we've discussed different routes through which you can invest. Let's start with the simplest route, the mutual fund or ETF route, which is Indian asset managers and the ones that where they're still taking the money. What's the taxation regime?
So mutual funds have, the offshore investments have always been classified akin to debt, and now of course debt after the last policy provision has moved to marginal taxation.
So it's your slab rate.
It's your slab rate. So from that perspective, it's not as efficient as it used to be. As far as your DIY offshore investments are concerned, any investment which is held for more than 24 months, because these are all technically investments in securities which are not listed in India. So they basically would qualify for long-term capital gains with 20% indexation if they are held for at least 24 months.
Okay.
If they are held for less than 24 months, it's basically short-term, which is really the marginal rate.
Got it. So since they're not listed in India, they're treated as unlisted shares or unlisted securities, and therefore that's the taxation regime that applies. And what about the third route? Some of the other funds that you spoke of for the more affluent investors, how are they taxed?
So like I said, the advantage there is that if you get into an accumulation share class, then essentially there is no income that's accruing to you because the dividend and what have you gets reinvested.
Okay.
So the tax liability then only comes into play once you sell the units of the underlying
When you're redeeming
fund.
your money.
That's right. Partially redeeming or full redemption.
And at that point in time, what's the tax rate that applies?
Then it depends if it's capital gains, and if you've held for 24 months, then basically you get long-term capital gains with indexation benefit.
Oh, so then that becomes a part of the capital gains regime.
That's
so it's
right.
10%.
That's right.
So listed or unlisted? 20% because unlisted.
Yeah, 20% with indexation.
With indexation, got it. So that's how taxation works. We've got that out of the way. But just walk us through some of the things that one must remember. Like you're saying, there's a lot of hype, and every time you watch stocks like Nvidia soar and you read about it, and there's a FOMO feeling as well, right? So how should one sort of look at taking that small bite-sized exposure to global equities?
I think the simplest way to get started is to essentially buy an ETF of a broad index like the S&P. Okay? I would say relatively speaking, it's the lowest risk investment that you can make to get started because it's a broad-based index. You don't have concentration risk. And if you see in a long-term 20-25-year tenor, the index has generated 7-8% kind of dollar returns, right? So I think that's the best way to get started. If you have information, you've done research, you have strong opinion of your own, then you can look at buying individual stocks. And like I said, if you don't want a passive strategy, you want a more active strategy, then you can look at these funds.
The AIF funds.
That's right. That's right.
I know that you folks at Trust Looters, you're running such a fund as well. So apart from the US, are there any other hot markets that are worth exploring? I mean, Japan's been hitting the headlines.
When we started the show, we spoke about Japan waking up after a 35-year hiatus, right? So I think the good thing is that if you benchmark yourself to the MSCI World Index, you pretty much will get representation across developed markets like the US, non-US developed markets, Japan, emerging markets. And like I said, that's the advantage of going through a fund structure because the fund essentially gives you global exposure versus just buying a particular geography or a particular stock.
Personally, do you invest in international stocks?
For 20 years, I've been doing it, ever since the provisions were like $25,000. Because like I said, I think the end use is, now if you see the data, almost $6-7 billion is going out towards educational expenses.
Right.
Now, this is a great way for people to save in US dollars for their future liability for their children, right? So that's a very valid end use.
Okay, I think that's a lot of food for thought and some very relevant points that you've brought to the table, Samir. Great to have you in the studio. Thank you so much for answering a lot of our viewer queries today.
Thank you for having me, Surabhi.
All right, well, it's a wrap on this edition of Let's Talk Money. Keep sending us your feedback and, of course, more questions, and we'll take them up in subsequent shows. See you again next week.
Let's Talk Money